insurance is the right life insurance? Well, here's the thing, everyone. No matter what anybody tells you, there are 5 different types of life insurance that are out there. And the real question is, what type of life insurance is best for me? Okay. A personal financial checkup is how we determine what type or types of life insurance may be the right or best or most suitable solution for your individual circumstance or for your household, which means there is not one solution that solves everyone's problems when it comes to life insurance. All right. I'll give an example in a moment, but here are the 5. We have term life, whole life, guaranteed universal life, variable universal life, and indexed universal life. Now, if you didn't get to write all those down, we're going to go through each one by one. So starting with term life. Term life is essentially leasing life insurance. So I am getting life insurance for a certain term or a certain amount of time, okay? And generally, when I purchase that term life insurance policy, the premium is going to be very low, okay? For example, when I came into this business, I was 29 years old. I purchased a $1 million life insurance policy, and I had preferred health at that time. That $1 million life insurance policy costed me $38 a month, including living benefits. Okay. Now, one might say, well, that's great. Let's lock that in and we're good, right? Well, the reason why I got that $1 million policy was because I had 4 young children. Now, my 4 children are not going to be young forever, right? And the financial need that exists in my home today may not be the same 30 years from now. But at 29 years old, I locked in that premium, right? Now, if we fast forward 30 years, so 39, 49, 59, now when I get to the age of 59, I can either throw away the policy because 30 years have passed, okay? And I do not, in most cases, get that premium back. I can choose to keep that policy, but now my premium is going to go up to life insurance for a 59-year-old, not a 29-year-old. Totally different cost. Okay. So let's say it goes from $38 a month to $350 a month. Okay. Because I still have preferred health, let's say. And every year it's going to renew again. So every year I'm going to pay more and more and more in order to keep that policy. Okay. Now, in most cases, that's not feasible for the average person, right? So when is term insurance a great idea? What I said, I have 4 small children, okay? When we have needs that will disappear over time, they will not be the same over time. Another example is mortgage protection. I think I was about 4 years into being a homeowner when I came into this business. So I had 26 years to go paying my mortgage, right? Based on that agreement. So that meant if I got mortgage protection for the balance of my mortgage, let's say it was $400,000, and I got a 30-year term for $400,000, that's protecting my mortgage. So if anything happens to me, my family can pay that off. But when that 30 years runs out, my home should be paid off. So it has served its purpose. So term is best for temporary needs. Okay. Can be a great way to utilize your coverage. Now, you see different options. They vary by company and they vary based on your age and other factors. Sometimes it could be a 10-year term, 15, 20, 30, and I've seen 35 years with some companies. So yes, it can cover financial obligations that will disappear over time. Okay, and also when we're younger, premiums are generally lower than for permanent insurance. So maybe also I just started my career. I just got out of college and I may not have the finances to do more. Getting myself protected and having living benefits is a great start. Now, the disadvantages of term, again, if that term runs out, I would have to pay a lot more. Most people end up canceling. Okay. 93% of people outlive their term policies. And also, term policies do not usually build cash value, meaning they don't allow us the option to get that cash accumulation. Okay. Now, the other 4 types of insurance are permanent, meaning we're no longer leasing life insurance. We are purchasing life insurance. And these type of life insurance plans are designed to protect us for the rest of our lives, no matter how long we live. So here is the basic structure. Our premium goes in. Now at 29, I also had 500,000 in permanent protection that I set up. And that plan at the time, I was contributing $250 a month into that plan. A lot different from $38. But that $250 was going to two places. Okay? A very small percentage, about $100 out of that 250 was going to the cost of insurance to provide a tax-free death benefit in my future. The other $150 was actual cash accumulation that was growing to provide me tax-free income in the future. So we cannot just look at the premium paid in a permanent policy and assume that's the cost of insurance, because we have to know how much is going towards cost of insurance and how much is saving and building up in cash accumulation for us in the future. Okay, so it is satisfying two things at the same time, all while being protected under that life insurance umbrella, otherwise known as IRS tax code 7702A, okay, which is what is allowing us to have that income tax-free access in the future. Now, when we look at the different permanent policies, they all can use different strategies on how that money grows or how that cash accumulates. We have three options. We have a fixed option, which will give us a guaranteed locked-in interest rate, okay? Let's say that interest rate is 3%, like this example, okay? This example is from 2000 to 2016, and it's based on the S&P 500 for that time period. Getting 3% every year, meaning it's not really looking at the S&P 500, it's just applying 3% of interest every year for 16 years. That 90,000 becomes 144,000, okay? Then our second option is a variable option. Variable option moves with the stock market. There are two guarantees with the stock market. It's guaranteed to go up and it's guaranteed to go down. We don't know when either one will happen, okay? So there are variable universal life policies that allow our cash to grow in this way. Then we also have the indexed universal life, which indirectly participates in the stock market. And when the market goes down, like it did from 2000 to 2002, the index says it will stay the same. That is the orange line. During the down times in the market, we will not lose, we will have risk protection. Then with the variable from 2002 to 2007-ish, okay, it started to go back up, recovering from the loss and continuing from there, okay? The index, however, does not take the loss and it goes up from where it left off. That's the orange line. Again, in 2008, we saw the market drop again, but if I am benefiting from the index, my money stays the same. That cash accumulation does not go down. And again, when variable goes up or the stock market goes up, the index also goes up, but to a cap. And that cap varies from company to company. So we get to choose how our money will grow. Will it grow fixed? Will it grow variable? Or will it grow fixed indexed or indexed? That is a very important question that we should be answering before we choose what type of life insurance we're going to get based on a permanent policy, okay? Because when we look right here at these other four types of life insurance, that is the biggest difference, is how the money grows, okay? Now I'm gonna set whole life to the side all by itself because whole life was the first type of permanent insurance. Okay, whole life was designed for a person to pay the premium until age 100 or until when they passed away, whichever one was sooner. Okay, and that cash accumulation was growing on company dividends that were about 3 to 4%. Okay, so basically a fixed rate. With the whole life policy, there was no flexibility. So what if I wanted to save more on the cash accumulation side? There would be no option. What if I wanted to pay a less premium because I just got laid off my job and I don't want the policy to cancel, but I just want to put enough in there to keep it going? That was also not possible. What if my family grew from 2 to 4 and I had a higher insurance need and I wanted to increase that death benefit? There was no flexibility with the whole life. So when you see universal life, the word universal can be interchangeable with the word flexible. Okay. It brought in flexibility for all of those examples. Flexible premium that we pay, flexible death benefit, an option to increase that death benefit or decrease it at different times based on the company. Okay. But still permanent if it is designed right. So it has to be designed to be permanent, because with that flexibility, I might underfund it if I don't know, or if I cannot guarantee that death benefit will be there for the rest of my life. So it's very important to know this. As you are entering and learning about this from an agent perspective, you want to be well trained on how to run illustrations to make sure that that policy is permanent for your client. Okay. And that cash accumulation, if I'm not interested in saving, I don't know why anybody wouldn't be, but if I'm not interested in saving in my life insurance, this might not be the best option. Okay. Because here you see guaranteed universal life gives me the fixed option to grow that cash accumulation. Variable makes that cash accumulation go into the stock market in mutual funds. And the index universal life uses that index, again, indirectly participates in the stock market and has averaged 7 to 10% of interest in the last 20 years. Let me ask you a question. When is the last time you saw 7 to 10% on average on a financial statement of yours? When I came to this business, I didn't know that that even existed anymore. Now, I'm the oldest child and oldest grandchild in my family. My grandmother made me responsible for paying her bills and writing the checks out and doing all that kind of stuff for her with her finances. And I remember a time where her bank savings account was giving double-digit interest. However, in my adult life, I haven't seen that. I'm not sure about you. Okay. So what are reasons why people would grow cash inside of life insurance? I'm going to give you the reasons right now. Number one, tax advantage. We have the opportunity to keep that same umbrella that's over the life insurance over our cash accumulation. Okay. Which means that our money, as it goes in as after-tax dollars, because it's from our income, that as that money grows and when we access it in the future, we have a way to have income tax-free access to that money and its growth. That's a benefit. Okay. Do you want taxable income in retirement or tax-free income in retirement? Another benefit, interest options. You see that 7 to 10% average. That's over the last 20 years. Is there a way for me to grow my money at a greater rate of return? Yes, that exists within life insurance. And another reason, compounding interest that you learned about yesterday. Compounding interest exists within life insurance when it comes to cash accumulation. So my cash can grow exponentially. Okay. So those are 3 powerful reasons why using cash accumulation in life insurance can help me to build wealth while also having the potential to protect that wealth using a fixed or an indexed option. So to recap, advantages of permanent insurance: if we fund it properly, it will provide protection for our entire life. Okay. Also, sorry about that. My slides just keep on moving on their own. Also, if funded properly, the premiums will not increase. Okay. You can plan and design a permanent policy for any type of scenario. Also, it can accumulate cash value that can be withdrawn in the future, income tax free. Disadvantages: if canceled early, there is usually a large surrender penalty. So for example, let's say I am 7 years into my policy, and in that cash accumulation, I have $15,000 there. That's my account value, but my surrender value is $10,000. That means if I canceled that policy early, I would get $10,000 and I would lose that $5,000 difference. Okay. So we will review the illustrations with our clients so they are aware of what that surrender penalty can look like if we cancel early. Life insurance is designed to be a long-term solution, not a short-term, not a flip the cash in a year type of solution. Okay. So it's very important that we communicate that. And this is why the PFC is so important. So we know what their goals truly are, and we can make sure the plan is aligned with their goals and their financial situation. Also, you must buy the life insurance and also save or contribute into the cash accumulation. You can't piecemeal it. You can't separate it. Okay, do one without the other. It is a package deal. If underfunded, that policy can lapse. Lapse is a word for early cancellation in the life insurance world. Okay, so if I'm not funding enough into that policy, it can run out, just like the fuel in the gas tank. If I'm driving and not putting any fuel in the gas tank or charging it up, then eventually it's going to run out. It will not be functional or operational. Okay, but again, those illustrations are how we determine that and can rule that out. So here is a sample illustration. Someone 40 years old, preferred non-tobacco, want to make that disclaimer, and they are deciding, you know what, I want to put in $20 a day, okay, to save towards my future and to protect myself and my family. So this is a $500,000 face amount or death benefit, and the person is putting in $600 monthly. So in total per year, that's $7,200 that's going in each year from age 40 until age 70. At the bottom on the left, you'll see that that person has contributed $216,000 into this plan. Now, based on 7.28% average for those years, that client in their account value has almost $600,000 of income tax-free money waiting for them. That is almost triple what they put in. By letting it accumulate and letting that interest compound, this is the benefit that they get to take advantage of. While at the same time having $500,000 death benefit, just in case, for their family, and also having up to $500,000 worth of sickness protection or living benefits. What we do is powerful. In the first 10 years, $72,000 went in. And already that surrender value, that's the amount that is accessible, or if I canceled in the 10th year, what I would get, $70,000. That's almost breaking even, getting everything back that I put in the first 10 years. Unheard of. Okay? You definitely want to get with your trainer and look at what this looks like for you. Run some illustrations, ask some questions, and if you haven't done your personal financial checkup, start there. But look at what this can do for you and your future and for your family. We're talking about building our own bank. We're talking about the possibility of generational wealth, not just for us, but for generations to come. Now, I stopped contributing in this example at 70 years old. So if you look at the circle down at the bottom there, it still says $216,000 that's been contributed. But remember, because of compounding interest, that $590,000 at 70, the interest applies to all of that in the next year, and so on and so forth. Okay. So I have, if I did not access this money yet, okay. Well, first, if I did access this money as income tax-free retirement supplement, then this example is saying I should take about $54,000 a year in income tax-free money to supplement my pension, supplement my 401k, supplement whatever it is that I may have, my personal savings. How many of you could do something with an extra $54,000 a year of tax-free money in retirement? Why not? Okay. That $54,000 is coming out every year from 71 until age 100. Look at the total there. That means I have accessed $1.6 million of income tax-free money when I only put $216,000 in to start with. Very powerful what we do here. And see, when we go to banks to set up plans, most people, we set up accounts in the bank because we're looking for safety. We're looking to make sure that our money is going to be there when we need it. We have access to it. In case of fraud, it'll be replaced, right? All of those things. When we go to investment companies, we're usually looking for a better rate of return because that bank maybe isn't giving us enough interest, and we want to have a way to earn more money or make our money work harder for us. And typically, as we go to turn to the life insurance industry, it's for tax advantage protection. Because I'm paying taxes on everything else, I'd like to have a place where money grows that I won't have to pay taxes. Well, that example that I just gave takes the best from all three of these industries and puts it all together. So we have safety, protection against loss or risk. We have guaranteed income. We have a rate of return that will not lose, even though the gains vary, it will never lose. And we have tax advantage protection, all in one. Don't you think you and everybody else you know deserves to know about that? I think so, right? So that is just a summary of life insurance. Now we're going to make a transition over to annuities. Now, an annuity is a tool, a very powerful tool that is used to give us a way to have lifetime income, generally in retirement. Now, some of you may say, I haven't heard of an annuity, or my grandma said, or my parents said that annuities are terrible, okay? Well, guess what? Social Security is an annuity. If you have a pension plan, that's an annuity, okay? If you have a 401k, they're going to offer that you put it into an annuity in most cases, right? So an annuity is something that we want to do to take our money that we would have access to and have to pay taxes on, right? So if you had $1 million in your 401k and you move that $1 million into your bank account, you now have $1 million additional income that you will have to pay taxes on in 2025. Anybody want to do that? Most people do not, right? So they're trying to figure out what their options are. So if I were to roll over or transfer my 401k into an annuity, instead of me pulling a little bit at a time out of that 401k, instead I have the option to put it in the annuity, and this company gives me a promise of lifetime guaranteed income, even if I outlive the principal. So let's say that company promises to pay me $7,000 a month. We're going to look at an example, okay, for the rest of my life. Even if I exhaust that principal, they're going to keep paying it. And if I pass away before I've exhausted the principal, then the remaining amount will be a death benefit to my beneficiary. So it is a way to help us not outlive our money in retirement. Another concern of that 401k. What if the stock market crashes when I'm 75 and living off that retirement account? In 2008, the S&P 500 dropped 39%. If I had $1 million 401k at that time and $1 million of it was in the S&P 500, then I would have lost $390,000 out of that $1 million in 1 year. How many of you could afford that type of hit? So another reason why people will consider moving their money is to also preserve those assets that I've worked so hard to grow and earn over the years. Now I want to make sure that it's there when I need it. So in that annuity, I can also choose a type of risk that is fixed or the indexed through life insurance companies that would provide me that risk protection. Then I also have tax deferred growth, because I will only pay taxes on the income that is being paid out to me monthly or annually. The rest of that money continues to grow tax deferred. Tax deferred means holding off on paying the taxes. So ideally, if I set this up right, the growth I get from that money is going to take care of the taxes that I will have to pay in the future. This also could be used to avoid probate, minimize expense delays, and unnecessary publicity. So let's look at an example, okay? Here is someone who rolled over $300,000 at the age of 60, okay, into one of the solutions that we provide. This is through F&G, okay? And this particular product has a roll-up rate of 7.2%. Now, a roll-up rate has to do with how the income is calculated, okay, that I'm going to get for life whenever I'm ready to activate it. So that income base, if you look at the income base there where it says 300,000 and 321,000, by year 5, let's say at 65, I'm going to take money out. I'm going to start to not take money out, but activate the income. So Why did we start this example at 60? I want you guys to write this down. At 59 years and 6 months, many Americans are eligible to transfer their retirement into an annuity, even if they're still working. So everybody you know who's 60 and above, even if they're working, you want them to get that personal financial checkup. They can get a head start on building up, rolling up that 7.2% every year, because that's how we got to that number, 424,000, is because 7.2% was applied each year in those 5 years. So now at 65, that income base is based on 424,713. Then their guaranteed withdrawal percentage is 6.55%, which is $27,819 a year. Now, this is from my 401k, my supplemental retirement. I have my pension, or I have my Social Security. I have my personal savings. I might have some rental income, but I also have this guaranteed income that's going to activate at 65 and going to give me that additional 27,000 a year. Now, if that's not cool enough, this particular solution also provides an impairment multiplier. And it says, if I have a chronic illness or if I need nursing home care, that company is going to automatically double the guaranteed income until my principal runs out. So I would get 55,000 a year instead of 27,000 until that principal ran out. And then it would go back to the 27,000 a year, not zero, but still the 27,000 a year. Very, very powerful solutions when we're talking about preserving our assets for a lifetime and taking care of us. Here's another example of an IRA rollover, someone who had an individual retirement account, and at 40 years old, they rolled over that 100,000 into a type of annuity that is focused instead of on retirement income, because a person's only 40, but it's more focused on achieving more growth potential utilizing the index. Okay, so in the first year, look at that. The account value, this is the best part, was 0%. Do you know what that means? That means the market took a hit. And that person, if they left it in that traditional IRA, would have lost money. But instead, they earn 0% because the index will provide risk protection. Worst case scenario, I still have my $100,000. Okay. Then as time goes on, the next year it earned 6.7%, 106,000. The next year it earned 20.95%, bringing it to 129,000. And then the next year, zero again, because looking at the stock market, it took another hit. So that 129,000 is still there. The next year, it went up 20%, which brought it to 156,000, so on and so forth. So we are still preserving those assets while giving it growth potential at the same time. All right. Again, 10 years later, I haven't put anything in but that 100,000 in that IRA. But my account value has more than doubled. It is at 223,000. Is that not powerful? A powerful way to continue to build up our assets. Now, as I said, we do not bring solutions to our clients without understanding their financial situation, without taking time to educate. That is all summarized in our 4 steps to create financial strength. We want people to understand that the daily decisions we make with our money can impact future value, thousands, tens of thousands, even millions of dollars difference. We need to understand how to protect our income and family with proper insurance, and also proper short-term insurance, and also sickness protection, right? And risk protection and tax protection. We also show people how to accumulate assets, taking all of those topics into consideration. How do they apply to my financial picture? And then we go to preserving our legacy. Now that we have this guaranteed income that is fully protected, how do we set up the next generation, and so on and so forth? All right. So that concludes our new agent training session 2 for today. Does anyone have any questions for me? And don't hang up yet because we will be taking a picture. So please don't hang up. Any questions?
I have a question.
Sure.
My name is Gerald Ponder.
Hi, Gerald.
Um, on the so for the annuity, you didn't
Yes,
mention
sir.
anything about the having a cap on the on your what you can earn. Is
Mm-hmm.
that it doesn't have a cap on it?
The cap varies from company to company and product to product. So
Okay.
yes, there is a cap, but
Okay.
based on that illustration,
Mhm.
that cap was higher than those numbers, which is why we
Gotcha.
want to see it, right?
Gotcha.
So it will vary, yes.
Right.
And that's why it's not enough even for me to just say I have the index. But I
Right.
want to know if I have the best index strategies,
Right. Right.
right? I want my money to work harder for me instead of me always working harder for it.
Got you.
All
Got you.
right, great question. Anyone else?
I had a few questions.
Sure.
But I'll start with my first one. I think we didn't talk at all about conversion, so around converting term to permanent. And I
Mm-hmm.
was curious, is that something that's offered? Is that not? Under what circumstances, etc.?
Great question. Again, because we are independent and we work with so many amazing companies, many of them do have term conversion options, but their terms are different. So they're not all the same. So one company may say you have 10 years to convert that term. Another one might say you have 20 years. Another may say it's based on how long your term is, how much time you have. And then those conversion options will be based on what that company provides. So a lot of the companies that we work with that have term solutions, they also have those permanent solutions like an indexed universal life, for example. So I could begin that term policy with the idea that I intend to convert it, but I would need to know those specific terms and what my timeline is so I can fully take advantage of that in that example.
Yeah, and I was curious particularly about this for people who are younger and maybe are not having as much cash flow and so are needing to do term instead of permanent. And so I didn't, I kind of heard you touch on that, but it was a curiosity to me around if it's even a good thing to explore with clients around term just as an entry point
Mhm.
with the understanding of conversion. But
So it was listed as a possible advantage for a young person on there, but also, again, it goes back to their PFC, their personal financial checkbook. So we will not jump ahead and recommend anything without seeing what their financial situation is. Here's the thing, Zoe, a lot of times because we're in an electronic banking system, most people don't know where their money's going from month to month. They have an idea, but when we put it on paper, it looks different, right? I had no idea that subscription that Apple, I signed up for, I meant to cancel it, forgot about it. And it's taken $50 a month away and I didn't even realize it, for example. So sometimes in the personal financial checkup, we will actually help people find the money that should be working harder for them, right? So we will not take their word for it. We'll look deeper together so that together we're coming to the right solution for them. And sometimes that is a term with a future conversion. Mm-hmm. Anyone else?
sorry, I have another question.
Sure. Yes.
Around, you said, I think we were talking about universal life when we were talking about that there's potential for it to be underfunded, and that's one of the disadvantages is like it can lapse if it's underfunded. Could you tell me more about how something becomes underfunded that is difficult for me to
Sure.
conceptualize?
Yes. The main reason is because we have flexibility in our premiums. And so flexibility could work against us if we don't understand how flexible we can be. Okay. So, for example, in 2020, I had clients who lost their income because of COVID. They had no idea when the money was going to come in. Even if they had unemployment, it didn't come for a few weeks or a few months, right? So they put a pause on their premium payment. Well, when they did that for these clients that I helped to set this up, they had been properly funding their life insurance prior to that event. So what that meant was part of their cash value went in to cover just the cost of insurance to keep that policy going. So they wouldn't have to pay. One of my clients didn't pay their premium for a year while they recovered financially. And so that cash accumulation they had built up was able to, just part of it was able to go and keep that policy open. If it was a whole life policy and I stopped paying, that policy would lapse. Okay, unless I paid up the part that was missing. There's no flexibility there. So if I continued, if that client left that payment off, or maybe they had decreased it down to $5, I don't know, whatever the amount is, different for everyone, then eventually there's not going to be enough to keep that policy open that's actually in there. Okay, so when we design a policy, we actually have within the companies that we work with, because they're so amazing, they already have no lapse guarantee function built into the illustration. So when we run those numbers, the numbers it gives us are guaranteeing that that life insurance is going to be there. Okay, so we review that with the client. So if I look at an illustration and it shows zeros after age 60, that means it's underfunded. They're showing me in the illustration, it will not protect this person potential for sure for the rest of their life. So that's not enough income that's going in, or premium that's going in. Also, we do annual reviews with our clients, right? So we're going back to see where they are, what has happened, because a client may say they're going to do something, but what if they changed it at some point, right? We want to review it with them and make sure they're still on track. There's still enough going in there to do what it's supposed to do. So it's very important that we as agents do our due diligence when it comes to that. And we also get support. We can get support from our trainers, but we can also get support from those life insurance companies as well.
Thank you.
I had a quick question. I put it in the chat. It just was, if you don't mind giving the definition for the roll-up rate again.
Absolutely. So I didn't say this, but within the annuities that are income-based, they're basically designed to give us that guaranteed income for life and not focus necessarily on growth in the index. So there's two parts. So you have your account value, which is keeping track of the amount that you put in and how it grows based on the index or fixed. And then over here, you have your income base. And that's the formula that's calculated to give you that guaranteed income, to determine what that number is. So the roll-up rate is the percentage they're going to apply on the income base each year, no matter what the index does over here. So remember how I showed that example? It went up 20%, then it stayed 0, and then it went up 5%, and then it was 0 again. In other cases, that might influence how much I'm going to take out in income. But over here, my income base, the roll-up rate says that 7.2% is added to that number every year, no matter what the account value is doing. So 10 years later, right, I've had 10 7.2% roll-up rates added to that number. And then they take that chunk and then take the percentage to determine my lifetime income. So it's giving me, in most cases, a higher amount of guaranteed income because it's not based on whatever is going on with the index, the stock market, or my fixed rate.
Okay. Thank you. That's going to be my other key to add. That's a great thing.
Yes, absolutely. Okay. Well, it is 7 o'clock on the dot. You guys were amazing. Thank you so much for joining us today for New Agent Training Session 2. New Agent Training Session 3 and 4 will be tomorrow at 6 p.m. Pacific Standard Time. Before we leave, we are going to take a photo. So if anyone who has their camera off is able to cut their camera on, we're going to take this picture really quickly that I will share with the managers. And thank you all for putting in the chat who you are, what city you're joining from, who your recruiter or your field director is. I appreciate that. It's great to see so many people from all over the country. That's awesome. All right, are we ready? All right, here we go. 1, 2, 3. All right. Thank you all so much. There is a different Zoom link for tomorrow, so make sure you have that, and we will see you then. Take care.
Great job, Keisha. Great
Thank
job.
you. Thank you, Jabari.
Thank you.
Wonderful.